And we are live. Hey, everyone. Good afternoon. I'm Angelique Ruers, CEO and founder of The Corporate Agent, where we are the leading experts in helping small business owners to win and work with corporate clients. And you are watching Lead Your Movement, which is our weekly show where we talk to business executives, thought leaders, and entrepreneurs about the movements that they are leading in order to drive positive change in the world and how they are leveraging the ultimate force multiplier, which is working with and through large organizations to drive their movement forward. And I am so excited about today's episode. We're going to be talking about the trend, the driver that is shaping everything in our world, not just in the business world, but in our personal lives every day as well. And that is technology disruption, which is touching every facet of business and life. And if you are a business owner, if you're a coach or a consultant or a small business owner, the technology disruption that is happening in this world is sure to shape exactly what your clients and your customers need from you. If you're watching us because you're someone who is an executive or a business leader inside the corporate world, then you too are going to walk away today with some insights that's really going to reshape how you're thinking about technology disruption. Because our guest today is one of the leading thought leaders on technology disruption. We're talking to a good friend of mine, a client of mine, and one of the most respected experts in this field. This is Paul Cuatrecasas, who is the CEO and founder of Aqua Partners, which is an investment banking firm. Paul is the author of Go Tech or Go Extinct. Over the past 30 years, Paul has completed over 50 M&A transactions around the world worth more than $25 billion and over 70 corporate finance advisory and strategic consultancy assignments. Paul holds an MBA in finance from Columbia University and a BA in economics from Wake Forest University. And most of the time, he lives in London with his wife and 3 children. Although these days, Paul, I imagine you are staying pretty close to home given the world that we're living in today. But Paul, welcome. Thank you for being here.
Thank you, Angelique. Good to be here.
So the first question we ask every guest is, what is the movement that you are leading?
The movement we are leading is one that is all about the world and every industry becoming a technology industry, becoming technology-dependent industry. And the specific mission that we started back in 2017 is to help those established companies, the non-tech companies, help them adapt, help them transform in the way they absolutely need to if they hope to survive, unless they choose to exit first. And we believe that the best way, the fastest way, most effective way of those companies adapting is to invest in or acquire the right technology, digital companies. Why? Because doing it all in-house might be possible, but it's extremely risky. And when you're talking about your strategic future, you don't want to depend on anything that's risky.
Yeah, well, that's for sure. But I'm going to play devil's advocate here for a second, because we all know, any of us who've worked with large organizations in the past know it can be like trying to turn a battleship around in a bathtub.
Yes.
Getting organizations to make a change, right? So why go this route and work with large organizations to try to get them to turn that battleship around? Because this is a big deal, going into a traditional company and saying, hey, you should be buying technology startups in order to transform. They don't really like change.
You're absolutely right. You hit the nail on the head. It's a very big deal. And I guess it was our calling. Someone had to do it, is the way I often think about it. And for some strange reason, maybe it's inherent in some entrepreneurs, we kind of like to do the hard things, or the things that are challenging, that have meaning. And this has a huge amount of meaning to me personally and to us as a firm. And I think it started when we started advising technology companies 30 years ago, nearly now, on how to raise capital, how to grow, how to exit, to help them fulfill their dreams and their destiny. And so much of that ended up in strategic deals with other companies and marriages, effectively. And the essence of what we have learned over these 30 years is that you must have a win-win. When it comes to tech and digital, TMT, we call it, you must have a win-win. You can't have win-lose deals. And what we have also seen over these, I guess, over the 25 years that led up to that 2017 decision, is that everything is moving exponentially faster. And in fact, if you look at a share price chart or the index chart and you map out the NASDAQ against the FTSE 100, the DAX, the CAC, or even the Dow Jones over the last 30 years, going back to 1990, you will see it's clear as day that the NASDAQ, tech-heavy NASDAQ, is literally a hockey stick. And it's not going to stop. It's not going to be stopped by anything now. We're only 10 to 15 years away, according to Ray Kurzweil, from the singularity. And this is real. You know, can tell you back in 2003, 2002, 2003, after the big dot-com boom and bust, I wasn't sure if tech was coming back. It was one of those things where we had the internet being birthed. We had deregulation and privatization of telecoms, 3G. And it was such a growth, exciting, hyped up period. I didn't know if tech was coming back. This time I can tell you that if we have a crash, when we have a crash or correction, it's not going to affect tech at all. I mean, yes, of course, the prices of the companies might reduce, it might come down. But the overall movement, the overall, it's not even a trend. It's an entirely new paradigm that tech is here to stay.
Yeah, yeah, it's interesting that you say that. Let me actually ask you a question about that, because I was reading, so Forbes just recently put out their top companies list, and they also, as part of that, Paul, and I think I may even have sent you over this study when it came out, but they were asking executives about how long they think it's going to take to recover from the economic impact of the pandemic and spending. And I have to tell you, I was really shocked by some of the responses. They seemed a bit myopic to me, in that, yeah, we're going to have, 12 to 24 months, I think, of a tough time. But how in the world does it not come back? How does the spending not come back? Because the genie is out of the bottle here in terms of the tech, the exponential growth of tech. When we talk about AI, we talk about advanced automation. Like, this toothpaste is not going back in the tube at this point.
Look, I mean, there are a lot of examples I can give you on that one. Let's roll back the clock to 2016 and let's look at GM. And GM, by the way, let's not forget, is a company that went bankrupt in the 08-09 crisis, and the U.S. government had to bail out GM and Ford. Yep. So since 2009, GM and Ford tracked each other in terms of their share prices as a pair trade. I mean, they were literally almost, every week tracking each other. Then GM did something different. GM in 2016 acquired a zero revenue software startup company, automated self-driving software company called Cruise Automation, for about $600 million. And there was a lot of questioning about why would GM do this, but GM looked out, as every company should do that cares about its legacy, cares about its future, cares about its ecosystem and its stakeholders. It looked out 10 years and said, in 10 years' time, we can be highly confident that almost every vehicle that is made 10 years from now will be a self-driving electric vehicle. And that also means entirely new ecosystems, new ways of ownership, fleet management, new ways of trucking, transportation, logistics. It means people won't be using transportation like they do today. And it also means an opportunity, right? It's an opportunity to win, to lead that globally. And GM realized that it was a real challenge to do that in-house when you have so many other competitors, not just your traditional peers like Ford and Mercedes and BMW and so on, but these tech disruptors. So GM decided to acquire the very best software company that it could find on the planet and work together over those 10 years to help reinvent itself. Even though it doesn't happen overnight, it may take 10 years to do. But it was a major strategic move that they had to, first of all, believe in. They had to have the right mindset that they can do it, that it's not just Google or Amazon or Facebook or Microsoft or Apple that can make these software acquisitions. It can be a GM, a company that had been bankrupt and had to be bailed out, that can acquire one of the best software companies in the world and reinvent their future. And the story so far is a very good one for GM. So the last capital raise, so GM has decided to raise money into Cruise and dilute its own interest from 100% down just below above 50%. And the last valuation was about $18 or $19 billion into Cruise. And GM is now ranked higher in the world among the self-driving companies that have self-driving technology. So these are the kinds of things, these are the kinds of deals. This is a large one, of course. Not every deal is that large, but this is the kind of thing that's now happening. Companies just have to do.
They just have to do it. And one of the things that you and I have talked about before is one of the reasons I want to have you on the show is because when you look at companies having growth, they're not able to achieve typically that type of exponential growth with internal transformative initiatives. This isn't, you're not talking here about, year over year revenue growth that's driven from just introducing a new product line, changing marketing, doing some cost savings. I mean, this is financially for companies. You can't really touch this kind of growth with another path.
No, and let me give you another example. And this is one that those in the U.S. will understand. It's a pretty basic one, and I don't talk about it that much. But given how things are going, I should talk about it more. A company called PetSmart, which is one of, if not the largest retailer of pet supplies in the U.S., was acquired by BC Partners back in 2014 or 15, I believe, for about $8.7 billion. So PetSmart was acquired by BC Partners. They only put about $2.5 billion of equity into this, so they put a lot of debt onto the acquisition of a bricks and mortar retailer, right? And it's not like they didn't know what the future was going to be in terms of moving to e-commerce and digital. And then they made a very smart move. They acquired a few years later a company called Chewy.com, which is an online e-commerce company designed for pets, for all the things you would want about your pet, your dogs, etc. And they paid just about $3 billion for that. So that was a third of what BC Partners paid for all of PetSmart. PetSmart's paid $3 billion for Chewy.com at a very high revenue multiple, a very expensive price. Now, that wasn't an easy deal to do. And of course, there was tension and problems, but strategically, it was an extremely savvy, smart, must-do move. And guess where PetSmart is today? And guess where Chewy is today? Chewy has continued to grow and done extremely well. They did an IPO of Chewy a year and a half ago. Chewy today, I think, is worth 18, 19, $20 billion. Wow. PetSmart still owns $10 billion, last time I checked, of Chewy. Plus its own business, PetSmart, has probably gone up in value. So this is the kind of reinvention we're talking about. PetSmart today, owning still a majority of Chewy, is an entirely different company that can service its customers so differently from just having PetSmart stores. It's an integrated experience, an enhanced experience for the customer that is the way. And by the way, this is just the beginning. When we have 5G and critical mass in 2 years, maybe a year and a half, 2 years, 3 years, we're going to have virtual reality, augmented reality, holograms. We have that today, but by having 5G, it's just going to be a completely different world. And so this affects all companies because it affects the human being. And the human being is the buyer at the end of the day, or user of whatever it is we're selling. So it matters.
It matters. Well, I'm so glad you said that. I'm sure there are probably some folks in our community who are thinking, I'm not really sure that these large mergers, acquisitions that are happening necessarily affect me if I'm, maybe a digital marketing company or I'm an HR consulting company. But the fact is that this is the kind of stuff that the senior leaders, the C-suite, is really completely occupied with, separate perhaps right now. Obviously, they all have the issues, the financial fallout of the pandemic and what that means for them in the short term. But long term, this is really what they're preoccupied with. This is the kind of thing that keeps them up at night. And it's also the kind of thing that trickles down all the way through their entire company culture, all the way down to the receptionist in the lobby. There's really no product or service company that works in the corporate space or really any space. We're going to start seeing this even have, trickle down effects into government and universities and everything in between. I did forget to mention at the beginning of the episode, you guys, we are live. So if you do have a question that you want us to talk about or something you want Paul to address, please let us know in the comments because we're happy to do that. So let me ask you this. What's going to happen to the organizations that don't acquire tech, whether they build it organically inside their organization, which is really, I think, has more risk because they're not necessarily the ones who can incubate those ideas. But what happens to the organizations that don't adopt disruptive technology and integrate them, whether into their supply chain their product suite, how they operate their business, what's going to happen to those companies?
Well, you can kind of predict what I'm going to say. A lot of them will go extinct. I mean, they're not going to make it. They won't be competitive, and that's just the way it is. I mean, I see it as clear as day. It's the law of gravity, and it isn't just using technology. It's not just licensing it, because everybody's doing that. And so whether it's an IBM, Accenture, a Big Four, or a Microsoft or a Google that you, the large corporate, are partnering with and signing deals with, guess what? Your competitors are doing exactly the same thing. It doesn't really give you much of an edge. It's something that you should be doing anyway, as you have been doing as a company for the last 100 years. Companies are meant to constantly optimize and become more efficient. You want to grow while you become more efficient, increasing your operating margins and increasing your return on equity so you can hire more people and grow and deliver to your stakeholders. That is just what you have to do. So if everybody else is doing it, how does that give you an edge? And the real challenge is the ultimate edge is going to be coming increasingly from the consumers or the customers who have increasing buying power, because they have this device at their hand, or they're going to have the ability to use robotics or AI or machine learning, 3D printing, CRISPR technology. I mean, I could go on and on. It's confluence of technologies that is causing some call it the fourth industrial revolution. We haven't even talked about food, which is, I mean, it's super exciting what's going to be happening in just the next 2 or 3 years, let alone 10 years. As I say, what I see in food over the next 5, 10 years is like the horse and cart going to the automobile, but maybe even more powerful than that. And so, for example, every company that's involved in the food industry, the agriculture industry involved, means if you sell seed, fertilizer, you sell water, power, energy, you sell food, you sell equipment, you own farms, you're a farmer, you could be anywhere in the ecosystem. You're gonna have a complete and utter revolution. Now, you could say that we've already talked about the automotive industry, we've talked about the retail industry. It's going to happen in banking. It is right now. Fintech is one of the hottest tech sectors there is. It's going to happen. It is happening in insurance, a little bit more slowly, but insurtech. Every single industry ultimately is going to go through effectively a major revolution. If you do not adapt, if you don't invest, then you're just not going to make it. Now, what we'd like to say is, if you're investing in-house only and you're recruiting people and you're building in-house teams, and it starts with whatever, chief innovation officer, chief digital officer, and then a whole team. Sometimes it doesn't. Sometimes it's completely decentralized and fragmented, and business units and business unit leaders have to become their own chief transformation officer. There's all kinds of interesting forms of this that we're seeing, and that's great. We love to see that, and it's critically important. All the successful companies, the examples I've given, others like Walmart and Home Depot and JP Morgan, the list goes on of companies that are doing this. We call it, techquisition, acquiring, investing in tech companies while they're also doing it in-house. You've got to be able to do some of this really well in-house. But ultimately, you really need to start to invest in the company strategically and own them, because it's not just the intellectual property, the software, the platform, it's the people. At the end of the day, actually, it's all about the people. So last year, McDonald's acquired a company called Dynamic Yield for about $300 million, I think, at about a 17, 18 times revenue multiple. So again, a normal investor, an institutional investor in McDonald's would say, whoa, that's a crazy price. But it's not crazy at all in the context of how McDonald's can leverage not just the platform, the software, and actually some of the customers of Dynamic Yield, but the people. And Daniel Henry, who's the global chief information officer of McDonald's, said, look, this deal is as much about the people, the data scientists, and so on that come with it as anything else, because they're going to help us, McDonald's, move faster. These new people with new ideas, who are fresh, who are entrepreneurial, and who are moving fast and nimble, they want to move fast and break things. They want to change the world. They're going to help us, McDonald's, change the world, if anything, just because of their ideas. And this is the beauty in these deals. It's not a marriage of integrating two different companies that have different cultures. It's a cross-fertilization of ideas based on the singular, exciting mission of we are going to change the world. And in many of these cases, some of the best tech companies have been working day in and day out, 24/7 for years trying to do that. And they've raised tens, if not hundreds of millions, some cases billions of dollars to do that. And they are starting to do it. But they will often reach a point where they think, you know what, if we're really, really going to change the world faster and better, we should partner. We should partner, selling a major stake, sometimes a majority stake, to a corporate who has the customers, has the channel, has the brand, has the balance sheet, the commercial know-how, and who care about this and who want us together, we can then make magic happen. And that's actually what is happening. That is what's happening.
It is. Well, and it's interesting because you said something that rings so true for me, Paul, and that is that these acquisitions are very different than the acquisitions of yesteryear, when you'd hear language around mergers of equals. One competitor would acquire another competitor, or you'd see an acquisition in order to get a new territory, new geography. This is a very different type. The way that the culture operates about when they acquire a tech company, it's a very different process. The culture of it is very different. And so I'm sure we could talk a lot about that as well. We did get an interesting question from Nina, and this sort of is a good segue to where I want it to go. She was asking, why are some companies out there putting tech acquisitions pretty low down on their priority list?
Yeah. Yeah.
And I'm curious also, how the current situation, I think it was Reuters this week, said CapEx is estimated to be down about 12% this year, which is more than we saw in the Great Recession of 2009. So I'm curious how that factors into all of this. Personally, I would think that tech acquisitions would actually be a way to survive this current situation. But why are some business leaders putting this low on their priority list? I mean, what do you say to those guys who are like, yeah, we that's not for us. We don't have time for this. We have other priorities right now.
Yeah, well, that's always been the case, hasn't it? And it's true now. It's a great question, and it is a great frustration to me to see companies that have such a phenomenal opportunity right in front of them to reinvent everything and to make their stakeholders so happy by just making a decision. That's all they have to do. It boils down to mindset. And that's what, again, look at any of these companies I've mentioned: Home Depot, McDonald's, JP Morgan. There's quite a few smaller companies like Lululemon, which announced the acquisition of Mirror last month.
Brilliant.
It's just the decision. It's just making the decision. And then it can happen like any other decision a corporate makes. It doesn't have to compete with any other priority. So I believe it is mindset, it's distraction, it is, well, we've just come out of a pandemic and we have a burning platform, and it's not going to be solved necessarily through an acquisition. And I would debate that all day long. I think it absolutely can, in many cases, be solved, in part at least, by the right acquisition or the right investment in the right company. It's often how you get out of these things. And I think the companies that just don't decide to go down this path will ultimately have to exit. Hopefully, if they are going to exit, it's before it's too late, before the share price starts to enter a terminal decline, which has happened in the case of so many companies over the last 2, 3, 4, 5 years. And look, one of the things that has kept the established companies afloat in terms of their share prices and competitive position in the last 10 years has been the very low interest rates. And so as long as they've been able to pay a dividend, an attractive dividend yield, they've attracted the institutional investors who don't have many other places to go. Going to bonds and so on isn't like it used to be when interest rates were normalized. And I think that game is going to end. It's going to end in the next couple of years, 5 years, if not before that. So why these companies are not taking this route is going to become, I think, more and more relevant for them as time goes on here.
Yeah, I think so too. I mean, at some point, you're either extinct, you're irrelevant, and you're extinct, or you're playing catch up. And for some of these brands, by the time they realize they need to play catch up, it's actually too late. And the market can get out in front of them. And I think
that happened in Europe last year with Thomas Cook, which had been around for 170 years, I think, and at one point was worth 10 or 15 billion euros. We talked to them 2-3 years ago, and they had some enlightened people in the organization, but overall, and I think this comes back to the previous question, the decision-making body, whatever that would have been, the equivalent of the executive committee in most companies, couldn't get clarity on that, and they couldn't get alignment on this. And instead, the debt facility that had to be refinanced probably took priority, as well as a few other things. But along the way, they tended to forget they had 500 stores in the UK where people used to walk into that store, to that travel shop, and book their holiday. You know, that's what you did for years and years. And it's almost as if they didn't realize that this thing called the smartphone has apps that allow you to do that with a few pushes of the button. And we had many ideas for a company like that, and they, just not interested, and they went bankrupt. And these are the kind of things that happen. Hertz announced bankruptcy recently. That was something that was on its way. Again, didn't have to happen. Toys R Us didn't have to happen. Sears, who bought Jet.com? Walmart, right? Jet.com has helped to transform Walmart. And Mark Lohr, coming in from Jet.com and running Walmart's e-commerce, has been a total game changer for Walmart as a company over the last 4 years. It's one of my favorite case studies. Just absolutely phenomenal. Doug McMillon is one of my heroes. Similar to Andy Grove, he's who said only the paranoid survive, and success breeds complacency, which can lead to the end of a great success. Doug McMillon said last year that we could go away at any minute. He totally gets it. And they have made many, many acquisitions of tech companies, including Flipkart in India for about $16, $17 billion. It's a great example of a company that's doing all the right things. And ultimately, they're doing it for their customer. That's where all this starts, is where's our customer going? What are they going to be buying and why? In food, we haven't really talked about that, but that's the big one. I was talking about Beyond Meat and Impossible Foods about three and a half years ago when we started all of this. I saw, there's new technology being deployed it's not like the old GMO-based modified foods. This is different. And so it was only last year when Beyond Meat did an IPO and was valued at the time, I think, $3 or $4 billion. Today, it's valued at $8 or $9 billion. Look, it's priced for perfection, but make no mistake, right? Customers are loving this product. Impossible Foods. We have now the Impossible Whopper. We have the whatever McDonald's call it, the veggie burger in McDonald's with Beyond Meat. They're going into grocery stores. They're going to restaurants. People are wanting it, asking for it. When you combine that with the movie Game Changers, right on Netflix, it's come out, where it's about being a vegan is really the way to be for all sorts of reasons. We're talking about billions and billions of dollars changing hands in an industrial way, ecosystem way. And these are major moves that are happening whether you like it or not. And so, the way we operate our business is that companies who get it, who understand it, but they're kind of half interested and they're going to follow it, we don't work with. I mean, there's really nothing we can do to help them because their mindset is not where it needs to be. But those companies that see it and they get it and they want to take advantage of it, we will work with them all day long, and they will be successful because they've got the mindset of we can do this as well as anyone else. And what's interesting is most of these established companies have succeeded in the past. They are where they are for a reason. And so over the last 20, 30, 40 years, it was relatively easy to remain in a leadership position, relatively easy, because you just had to block and tackle. But today, you've got to do more than block and tackle to be able to win, because you've got these tech disruptors, these unicorns, as we call them, private companies valued over $1 billion, that have gone from about 20 or 30, 8 or 9 years ago to 500 of them today. And together they're worth $1.5 trillion. And you may say, well, that doesn't determine success and it's just a lot of money raised. And, so what? They raised a lot of money. Well, there's a reason why they raised a lot of money. And it's not another dot-com boom. I mean, yes, there's a boom. Yes, there's possibly some overpricing there, but the value is there, and there's huge value, and it's just continuing to grow. So these unicorns themselves are growing in value, and they're taking market share. And guess what? These unicorns are formed by driven entrepreneurs who are hungry for success. And frankly, they want to kill. They want your customers. They want to win. They want to be the next Amazon, the next Google and Facebook. And if you as a corporate don't believe that they're coming after you, it's going to be ugly. And I think we're going to get to the point soon, and this pandemic is what woken some people up. I think we'll get to the point where more corporates are realizing, we're going to have a problem here. We're starting to lose share. We're losing. Last year, I think it was September, October, the institutional shareholders of Kraft Heinz publicly said, just before the annual general meeting, that they weren't too happy with management not adapting to plant-based protein. Again, it was the Beyond Meat IPO. and the drop in Kraft Heinz share price. And they publicly stated, look, we're not too happy with the way things are going. And I think we're going to see a lot more of that.
One of the things I've found very fascinating about watching this whole movement, Paul, is watching the brands that wait and then their hand is forced to do something because the technology disruptors have redefined the game. And then the more traditional brands have to play catch up. They're almost on defense at that point, which means they're no longer really that sort of like the master of their own destiny because they didn't sort of shape the direction the market was going. I think of Rent the Runway, for example, right? Who redefined the fashion industry. They successfully negotiated, for better or for worse, we can argue, they successfully negotiated very exclusive contracts with a lot of brands that locked other companies completely out of that space. And now you see brands like Saks Fifth Avenue and Bloomingdale's and some of the more traditional retailers trying to figure out how do we get into this space? But the space has already been defined by the technology disruptor. And so now they're having to try to retrofit into that lane. So yet again, they're still not the masters of their own future. And I think that's pretty interesting.
You're spot on. They're falling behind. And one of the things I talk about in the book is market power today is everything. It's not about revenue. It really isn't. The Fortune 500 should be redesigned and redefined. A little bit like some people say GDP should be redefined for all sorts of reasons, I won't get into now, but the essence of market power today is what matters. It's not revenue, number of employees. In fact, we designed a measure we call body value, which is the enterprise value divided by the number of employees, to understand the strategic flexibility of a company, which is important if you want to work for that company or you want to invest in that company and you're looking at it from a competitive positioning perspective. But the power that the big tech has today, where they are already worth over $1 trillion, and they're generating billions of dollars in cash flow every quarter and have hundreds of billions of cash on the balance sheet. You can't compete against that at some point, and you can't compete against their ecosystem. So it isn't just the Microsoft, the Google, the Apple. It's all of their partners and suppliers who are tech companies who are also getting where the consumer is going, and they can move very fast. And they have power. These unicorns have huge amounts of capital, and they can attract hundreds of millions of dollars from VCs. That's power. The established companies, they're stuck. If they're still somewhat complacent and they have these competing priorities and there's inertia, they're just not going to make it. And so I say to investors today, why would you? And I'm sorry to say it, but it's a reality. Why would you invest in a traditional legacy company? Maybe you think you're going to get a dividend yield, and you don't get dividends with the tech companies. But that dividend should not be an assumption that you make. That dividend can go away, just like Doug McMillan said. It can go away at any minute, and it is going away. By the way, that dividend is absolutely going away for so many companies. So I think that this notion of market power is extremely important. I mean, today you mentioned Saks and Bloomingdale's. I read today that Brooks Brothers just filed for bankruptcy, which again, it didn't have to happen. I mean, it's interesting that yes, people have not been wearing as much formal wear in the last 6 months or last year, 2 years as 20 years ago. But what a phenomenal brand name and infrastructure and platform. It's a shame to see these things happen, but I think we're starting to see why now these things are happening. And I think it's dangerous to assume that it was because of the lockdown or the shelter in place, the pandemic, that's an excuse. It's not. These things are just been accelerated, but they were inevitable.
I was going to say it was an accelerator. It was sort of an accelerator of the inevitable in a way, right? Of those things happening. A couple of great questions came in for you, Paul, and then I want to shift gears just a little bit. Speaking of being sort of the master of your own destiny, you were really out in front of the market on this, so I want to hear some thoughts from you on that. One question that came in was around, what kind of questions can you ask corporate leaders to help them see the need to invest in these technology acquisitions? What do those conversations sound like? Or does it sound a lot like the conversation we're having today? Your company, one of the things that Aqua Partners, your firm, does is bring insights to these decision makers that are not necessarily publicly available. That's one of the things that you're doing to lead this movement, is really get in there and have conversations with these folks about what's really happening, and helping them see, hopefully, their path to the future.
No, that's right. So the questions we ask are around the things that they should care about. So we ask about innovation. We ask, what's the structure of innovation in their company? Is there a division? Is it fragmented? How much do they spend on innovation versus R&D versus product management? How do they spend on innovation? Is it in-house people, employees, outsourced people? Is it consultants? Do they have innovation programs? Is it built into day-to-day work? How often do they report back on innovation? How has the spend been increasing or decreasing? We ask about those things. We ask if they've made any investments in any companies at all, whether it's corporate venture capital or incubators, or whether they've actually acquired companies. We ask about talent, because look, these are the things, I've talked about them already, that are what you get when you make a tech acquisition, as we say. You get ideas. You get, of course, you get the platform and the software. You get the people. So we ask about, how many people have you lost as a company in the last year, 2 years, that you didn't want to lose? Talent, sales talent, marketing talent, coding talent, development, innovation talent. How many have you lost to either your competitors, i.e., let's say an auto company that's not innovating, to maybe a GM Cruise? How many people have you lost to a tech disruptor, i.e., a Waymo, the Google automotive outfit? How many people have you lost to a startup company that's receiving venture capital, that's offering your executives options or shares or warrants? That's important. How many people have you lost, and how are you losing them? And is that frequency increasing or decreasing? And then how many people have you been able to recruit, that you wanted to recruit, that you really wanted to recruit, to fill extremely important positions? So not necessarily CEO or a C-suite, but below that, where the action's happening, boots on the ground. In the middle management is where you get the immune system kicking in, right? That is the problem in these companies typically, is you get an enlightened C-suite, an executive committee. They may not be all aligned, it may not be clarity, but they get it. It's the middle management that often is rejecting all of this, because it's rejecting change, and maybe I risk my job, I don't want to do it. That is what mindset's about. That's what you have to change. And so these questions are designed to understand where their head is, and to understand, if they are doing the right things. And by the way, if they really are losing a lot of talent and they're struggling to recruit talent, then they got to do something. So we ask those kind of questions. We ask about customers. In many cases, depends whether it's B2B, B2C, whether they're retaining customers or losing them. If so, how are they losing them? Is it a broadcaster losing them to a Hulu or Disney Plus now? That's a fascinating sector to talk about disruption. So we ask about the things that they care about, that are core business, things that move the needle. We don't necessarily talk about acquisitions and mergers and investments. That's the effect. So I'm a great believer in the cause-effect relationship, 80-20 rule. And so we focus on the things that are the source, the cause, mindset, number one. I mean, you may have seen this Last Dance about the Bulls and Michael Jordan. And, the whole reason why that franchise became so successful, or one of them, was Michael Jordan's belief that even if we're up by 50 points, we're going to keep going. We never, never, never give up. We cannot, because we don't know how to, and we have to keep going, otherwise we're dead. And it's true with probably any person, but also with any company. You must have that mindset. So our questions are designed to understand, what kind of mindset do they have as a company? How badly do they want this? And because it really comes down to that to start with.
Yeah, those are brilliant questions. I think for all those of you in our community who work in the corporate culture space, in the internal culture transformation space, the leadership space, the mindset space, everything that Paul just shared with you is really gold. Because, so often when we talk about those things, it's in this sort of airy-fairy way, as opposed to really being tied to the relevancy and the future success of these organizations continuing to exist and continuing to do what they do in the marketplace, and not creating that complacency, which is so strong. The amount of inertia inside these organizations, as you said, Paul, at that sort of middle level, it's just unbelievable. But also, I think you can look at the organizations that have had lack of leadership at the top of the organizations as well. I mean, you look at a JCPenney or a Sears, and they have been plagued by sort of a lack of strong leadership at the top, just really rudderless for decades. And you can't, it's surprising actually that they're still surviving. So you just shared some really golden nuggets for everyone. I want to ask you a couple of more things. Now, I have the advantage of having worked with you. You've been an elite client of mine. You're in our Velocity community of business owners. So I happen to know some of these answers, but for the benefit of our audience, I'd love for you to talk just a little bit about this. So when you started Aqua Partners and you went out there to start doing this work, you really saw what was coming for these organizations earlier than what a lot of senior leaders, unfortunately, humans are humans. We're all focused on fire drills that are in front of us today, this week, next month. Sometimes it's hard to get humans to look a few years down the road and take measures now, like preparing for a pandemic. It's a perfect example of the ineptness of government around the world to prepare, even though people have been screaming for decades now that we would face a pandemic, right? Perfect example. But as someone who got out in front of the marketplace, what are some of the things that you did to start educating senior leaders about what they need to think about? What are some of those sort of tangible things that you had to do to re-educate the market and get senior leaders more focused on this issue of acquiring tech startups?
Yeah, well, it was hard. It was hard. And most people would say that I was crazy because it's just not what you do, right? If you're an investment bank, trained investment banker, entrepreneur, advisor to tech companies that are growing and doing well, and you're doing well raising money for them and selling them or advising them on a trade sale, a strategic deal, why would you do something that we call it on the buy side? Why would we help, especially large corporates who are not tech companies, advise them on tech? It's just, you just wouldn't do it. You don't do that. And I think you're right. I think it was because I had been doing it since the early 90s. And I remember, from the big phones and the first days of the internet, we did business before the internet, before email. And because, I personally experienced almost subconsciously the changes incrementally every year, seeing, from MySpace, Friendster, MySpace, Facebook, just seeing everything in the whole tech communications ecosystem change. It was building. And we started showing some tech companies to non-tech companies for sale back in 13, 14, 15, and not much interest at all. And then Walmart acquired Jet.com in 2016. I fell off my chair. I couldn't believe it, long story. And that's when I started asking my team and my advisors at the time, maybe we should look closely at this. Maybe there's something going on here. And we did some research, and it took about 3 months. We looked at every industry to see what was going on, and we found that there was absolutely a trend of non-tech companies investing in acquiring tech companies. It wasn't just a one-off with Walmart or Under Armour buying MyFitnessPal and GM acquiring Cruise. And so I then did a strategy session back in late 2016. I think it was early 2017. Looking at, well, what should we do about this? And we just decided, like any corporate has to do, is make a decision. We decided to do it. We decided to create the word techquisition, to trademark it. We decided to come up with a methodology, which we spent a long time doing, probably a year and a half, 2 years, 12-step methodology, really thinking carefully about every single step, so that similar to the Japanese zero defects policy, by the end of the process, if you're doing a deal, an acquisition of a tech company, you should have almost no risk. And you should have a very clear idea of what your upside is and how valuable it can be to you. So we did all of that, but then we didn't, this is really the question, what do you do with it? Because we didn't know anyone in automotive or banking or insurance or retail or you name the industry. We knew tech, telecom, and media. And so at first we sent letters with content in the Post, and those letters, of course, they worked in 1995. They worked very well in 1995, but they didn't work in 2017. They really didn't. I mean, it was amazing how many envelopes came back to us. It was a joke, really. Why did we even try that? Well, we didn't know what else to do. So it was then we did research and we decided to do cold emailing, which is a topic of very hot debate. And I'm an expert in that now, I'd have to say. Lots of pros and cons to that, but we did it. We hired a firm to help us with a very high-level, serious cold email campaign to the C-suite executives of the Fortune, 1,000, Fortune 2,000 companies mainly in Europe, UK and Europe, because that's where we're headquartered. And we were targeting getting 100 meetings because we just thought the best way to do this is to do it properly. It was a very long email that we sent, and very well written, not like any other email you would get, I can tell you. And we had the sequence of 5 or 6 emails like you do, following up and so on. And it worked. We had the expectation of getting 100 meetings, 100 different companies, I should say, at CEO, CFO level. And within a year, we had over 300. And we had to stop because it was just too much. And now that was great. So we had open doors. We developed a lot of relationships. And we actually won quite a few clients, more than I expected.
And you learned a lot.
We learned so much. And I was able to write a book. And it was that time when I decided, look, this is going to be so hard. I should probably write a book. And I think I was introduced to Robin through you, Angelique, because she had done your program. And so Robin Colucci helped me enormously with that. Just first of all, persuading me that it's possible despite being so busy. And I think that's helping now. So it came out end of last year, and now it's
Can you share your book? Can you share your book and
sure.
where everybody can?
It's this here.
Go Tech or Go Extinct.
Go Tech or Go Extinct. And it's really it's all in there. I actually just went to the recording studio a few weeks ago to do the Audible version, and I was rereading the whole book again, smiling, thinking, oh my God, I don't normally say this about myself, but I couldn't believe how much of what I was writing 2 years ago has absolutely happened and come true, and how I see it more strongly now than ever. In fact, when I came out of the studio, when I finished it, I felt angry. I felt like I can't believe how true all of this is, and it's becoming, and it's, to me, so obvious. And again, I think also as an investor, I've been an investor for a long time as well as an advisor. And as an investor, it's just so crystal clear. And so much of what I see in the world is nonsense. And it was very interesting to see a Financial Times article a few weeks ago about Warren Buffett and how Warren Buffett missed it. And I couldn't help posting that Warren Buffett had an opportunity to decide. He said, I don't invest in anything I don't understand, which is very good advice. He had an opportunity to understand tech 10 or 15 years ago when his best buddy is Bill Gates. Who better in the world than Bill Gates to help you understand, or your team understand technology? But he just decided, that wasn't what he's going to do. And now the returns have been affected. He's frankly missed out on frankly massive gains that aren't false gains. I mean, they may be for a period of time as we have the next correction or crash, but long term. So it's a very hard road, and I have to say I didn't know how long, how painful, how expensive it would be going into it, but I would do it again because there's nothing more rewarding than actually seeing something, maybe early, believing in it, but knowing that you have this stamina, which I think entrepreneurs have, true entrepreneurs have, having the stamina to go as long as it takes. Many technology companies are bankrupt today because they were too early. Many great companies, they were just too early. They had the right idea, but they were years too early. The problem is in tech companies, you've got to raise a lot of capital, other people's money. You spend it, and if you're not delivering exactly on the timing or close to the timing they expect, you're not going to raise more money and you're out of business. And we weren't in that position. We're not having to invest to create a new product. So the question was more, as long as we kept our core business going, which we have and it's growing, that's the traditional sell side business, we'd have to work a little extra harder to build this new business as well. And I just made the decision that as long as it's future proofed, that was the key, was every day that goes by, more and more people, not just the executive suite in large companies, but everywhere in the world are realizing how every industry is starting to change and how we're starting to change. And it's just a matter of time. Even if it takes another 2, 3, 4, 5 years, that's okay with me. Because and I'd say this to every entrepreneur and certainly in your community, Angelique, that if you can find something that you believe in, you have a mission, and you can attach yourself to it, take a deep breath and just say, it may take 5 or 10 years, and that's okay. it can give you energy, and it can keep you sharp, and give you all the things you want that are painful and difficult, but also, and I was reminded by a Seth Godin quote I read a week ago, saying, great ideas, you have to have a great idea, an idea that to create a result and a great output. But he said, for every great idea, to get to an execution outcome, you have to go through like 100 iterations, 100 things that will happen, that will surprise you and will depress you and get you down. And it's like you're about to win the basketball game, and then the team steals the ball and makes a shot and they win. And okay, you get right back up and you do it again tomorrow. And I think that's, I kind of wish, yes, I had known that a little bit more when I started, that it would take as long as it has. But look, it's okay. And as you said, we have learned so much, and without the learning, you're not able to be as valuable to your clients as you would otherwise be. So it's all part of, it's a holistic approach. It's a mission. And if you go all in, that's what matters. And you will get there in the end. You'll get there.
Yeah, very sage advice. And having worked with you, I will tell everyone that, two things that have been, maybe I should say three things, I feel, Paul, that have been so consistent for you and Aqua Partners in leading this movement is, number one, building on 27 plus years of knowledge and experience, having seen mergers and acquisitions, having led those over $25 billion in transactions. So you really built this based on decades of experience, having seen where things had been and then watching where things were going. And then you really defined the language and the proprietary methodology around this. And you said, look, we're going to do the research on this. We're going to take a look at this. We're going to put together some rigor to bring to where, because the market's going to need rigor for this. They're going to need a path to follow, and we need to have language to talk about it. We need to have a path for our clients, because they don't have a playbook for doing this, because this is evolving. So we're going to create what that looks like. And then from there, you did the most important thing in my mind, which is prioritize conversations with folks, which can be exhausting, but you probably have done more conversations on this topic than anyone in the financial industry, anyone in the investment banking space. Aqua Partners has done more conversations with decision makers across organizations and on the tech side, as well as on the traditional corporate side, to really understand the mindsets, the challenges, the internal inertia, all of the pieces to that. And so, I had a front row seat to watch some of that, and it's been absolutely phenomenal just to see how you've taken all of that and then been able to bottle up that expertise and that insight, and then use that to grow the next level of your organization. And I think that's been really masterful, the way you all have done that.
Thank you.
So as we come up here on the top of the hour, Paul, for those who would like to, where can they find your book, and where can they find you and Aqua Partners? What's the best way for people to do that?
Yeah, so the book you can get on Amazon, and Audible will be out hopefully in a month or two. Apple Books, wherever you would normally buy books. And our firm, you can find Aqua Partners. It's AQUAA partners.com, or just Google us, Google me. You'll find us.
That's awesome. Paul, thank you so very much for being here with us today. I think, as far as the future goes, perhaps the only other thing that rivals tech disruption is what we're going to see on the climate front. And of course, those two things are completely interwoven with one another. So Thank you for sharing this with us. And I'll tell you guys, I've read Paul's book cover to cover. If you want to understand where the business world is going, what's keeping decision makers up at night, how they need to be thinking, whatever it is that you offer to the corporate space, you have to understand what's at play in technology disruption, because it's really driving everything. And so I highly recommend you get a copy of Paul's book, whether hard copy, mine is pretty marked up, or the Audible version that's out soon. Paul, thank you so much for being with us.
Thank you, Angelique.
As we sign off today, we're going to leave you with just a sneak peek at our upcoming event, The Real Deal. All right, everybody, have a great afternoon.